There's a moment in every trader's journey where things go from chaotic to clear. For me, that shift came when I stopped chasing every ICT concept I came across and focused on just the few key ones. Before that, my charts were loaded, lines on every time frame, conflicting signals, constant second guessing. But after I dialed into these 5 specific ideas, everything changed. Let me walk you through the 5 ICT concepts that helped me go from confused to consistent. If you're new here, I'm Ali Khan, former pharmacist turned full-time trader. After spending almost 8 years decoding this thing we call algorithmic price action, and as a private student of Mr. ICT himself, I now teach people how to read the market like a machine. Not with indicators, not with guesswork, but with real logic, timing, and a deep understanding of how the algorithm operates. Let's get into it. First up, we're starting with liquidity, because if you don't get this, nothing else will make sense. The market moves towards areas of interest, and not because it wants to go up or down, but because it needs to fill large orders. And large orders require volume. Where is that volume? Above relative equal highs or double tops, and below relative equal lows or double bottoms. Basically, anywhere retail traders are placing stops. So this includes your trend lines, head and shoulders, flags, bats, and whatever other animal pattern they think affects market price. Think of liquidity as bait. The algorithm leaves it in obvious spots because it knows you've been taught to trade support and resistance and breakout levels. So what does price do? It raids a high, triggers buy stops, fills institutional sell orders using that retail liquidity, then tanks to an opposing pool of liquidity below an old low. Or it wicks below an old low, grabs sell stops, triggers fear, and then rockets upwards. That's not manipulation. Well, it is, but that's the business model, right? Here's an example. Ever bought a breakout just for price to reverse instantly and stop you out? That wasn't random. That was liquidity being engineered, and guess what? You were the liquidity. The second concept is the dealing range. The dealing range is the box the algorithm operates within. It's one of the most important concepts to understand if you want to learn how ICT concepts fit together inside of a framework. It's something I have dubbed dealing range theory, or DRT for short. It's the defined high and low of a significant move after some form of manipulation. Once the dealing range is defined, the algorithm will trade back and forth inside of it. And here's where most traders mess up. They try to chase trends, and they totally ignore context. But once you identify the range, you know exactly where price is likely to reverse, consolidate, or expand. I define these as the 3 different types of dealing ranges. I'm going to make a separate video on this, so make sure you subscribe to the channel. Think of it like this. High of the range, that's premium prices. Low of the range, that's discount prices. And middle of the range, or equilibrium, is a fair price between the highest price and the lowest price. Makes sense, right? Here's a tip. I'm not trading price. I'm trading the behavior inside of a range. Where are they engineering stops in relation to that defined dealing range? And where has the damage already been done? Number 3 is inefficiencies. This is where the algorithm leaves clues. Inefficiencies, also known as fair value gaps, are the imbalances the algorithm creates when moving too aggressively without enough counter orders. Think of it like skipping steps. The algo doesn't like leaving unfinished business because it's extremely efficient, so it'll often return to that level to rebalance. What you're looking for is a fast candle that moves with no overlapping between wicks, usually a 3-candle pattern. I explain more about these and the other concepts I'm talking about in my ebook, Market Maker Secrets. You can download that for free in the link below. Now, fair value gaps act as magnets. Price often pulls back into the fair value gap before continuing. The key isn't just spotting them, it's knowing where they matter. Combine this with liquidity, time of day logic, DRT levels, and you've got yourself sniper entries. Here's a common mistake though. New traders mark every single fair value gap. Don't. Not all imbalances are worth trading. You want to stack it with narrative. Was liquidity just swept? Are we in a premium? Is the fair value gap during a kill zone? And here's a tip. The first fair value gap after a raid on liquidity is going to be a very high probability fair value gap, especially if it overlaps with the 25 DRT level. I have a whole video on the DRT model. Go watch that after this, and it's a total game changer. Number 4, premium versus discount. This one's simple but brutal. It's a pricing model that tells you if you're buying too high or selling too low. And here's the logic. Anything above 50% of a dealing range, that's a premium zone. So you want to ideally sell in a premium. And anything below that's a discount zone. So technically a buy zone if you're going long. Once you draw that 50% line across your range, everything changes. Now, instead of FOMOing, buying green candles at the top, you wait. You anticipate, you position yourself to buy cheap and sell high like the institutions. If you combine this with a type 1 dealing range in a bullish market, call your boss and tell him that he's fired. I'm only joking, but make some money first. But this is how I stopped chasing candles. It gave me patience, and let's be real. If you can develop patience as a trader, you're already better than 90% of the game. Number 5, and my most powerful one, is the power of 3. It's a really powerful framework for filtering high probability trades. It explains exactly how price is delivered during a session or a day. And it goes like this. The first step is accumulation. Sideways chop where the algorithm collects orders, generally during something like the Asian session. Step 2 is manipulation, a fake move that triggers stops and raids liquidity. This occurs usually post after 12 a.m. New York Eastern Standard Time. And step 3 will be the distribution, the real move in the intended direction. Now, using the 12 a.m. opening price as a filter and only buying below it if you're going long is a really great way to filter out poor quality setups. What made this click for me was realizing that everything I was taught to avoid, the chop, the wicks, the fake outs, that's where the actual edge was. If you know the open and you know the dealing range, you can anticipate where price might drop to below the open, where it wants to deliver to above a previous high or a fair value gap above the market. And this is why I called it the one candle that changed everything, because when you understand the model, you stop being reactive and start becoming more surgical. There's a deeper breakdown waiting for you about the power of 3 inside of my webinar. It's free and you get it when you download the ebook in the link below. I drop a ton of gems in that, so it's really highly recommended that you check that out. So that's it. These 5 concepts, liquidity, dealing range, inefficiencies, premium versus discount, and the power of 3 are literally the backbone of my entire approach. I didn't learn this overnight, obviously. It took years of getting stopped out, chasing breakouts and watching price do the exact opposite to what I expected. But once I stopped fighting the algorithm and started understanding how it thinks, literally everything changed. Drop a comment if you want a dedicated deep dive into one of these next, especially the power of 3 or liquidity rates. I've got plenty of chart breakdowns coming and I have almost 8 years of knowledge to share. Like, subscribe, and as always, think like the algorithm. I'll see you soon.